The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Global markets on edge as the U.S. drags the world into unknown economic territory. Romaine Bostic here with Alex Steele, counting you down to the closing bell and counting you down to President Donald Trump, who in 1 hour is scheduled to unveil a series of protectionist policies that would eclipse that landmark Smoot-Hawley tariffs that sparked the first truly global trade war 95 years ago.
And I can tell you about markets doing absolutely nothing. Complete wait and see for that. The VIX a little bit elevated, maybe a little bit of selling in the bond market, reversing earlier, buying gold off its record highs. But look at that. You would not think that in 60 minutes time, the tariff world will be completely transformed. And yet here we are, the S&P up by 6 points.
And an absolute volatility. An S&P that was down by 1%, up by 1% at one point on the day. As we get closer to that announcement, the volatility may pick up, and tomorrow may prove even more consequential. As we drumbeat to that big announcement by the president, we have coverage around the globe from Mexico, from Canada, as well as over in Hong Kong. We start off right now with our man down in Mexico City, JP Spinetto of Bloomberg Opinion, to talk a little bit here about what the Mexican response might be to what we learned tonight from the U.S.
Yeah, I mean, there is a tense weight here expecting this announcement of President Trump. If there is a country that has a lot of stake with this possible tariffs, is Mexico, right? Is a country that is the largest trading partner with the U.S. It has had more than $800 billion in bilateral trade. And so far, the attitude has been one of patience and appeasement. President Claudia Sheinbaum has been trying to avoid controversy, has been improving some of the requests that the U.S. have been asked in terms of the migration, the fight against narco-terrorism, and all of these points. But there is a limit to that. And so far, Mexico is already being affected by tariffs. There is this 25% of tariffs on non-USMCA goods that have been in place since March. Also tariffs on steel and aluminum. And depending on the response today, she can follow up that with a retaliatory measures starting tomorrow.
All right, JP, thank you very much. We appreciate that. Bloomberg's JP Spinetto joining us. And China also taking steps to restrict local companies from investing in the U.S., a move that could give Beijing more leverage for potential trade negotiations with President Trump. We find Steve Engle for Bloomberg News in Hong Kong, waking up early for us. Hey, Stephen, talk to us about what we can expect out of China in the next 24 hours.
Well, obviously, there's the direct response to the tariffs or the unknown amount of tariffs. I think that's the key question. Right now, they've already kind of figured out their calculus to deal with the additional 20% that Donald Trump in the first 2 months of his second term has already implemented. That's on the fentanyl issue. So that is something that China is trying to figure out exactly what does Donald Trump's administration want on that. What are the deliverables there? But if there's going to be additional reciprocal tariffs, upwards of 20% additionally, which could essentially, on average, levy about 52.8% across the board on all Chinese exports to the United States, that's a different calculus. So what they're doing is they are shoring up their domestic economy, making sure they have end available markets, their own domestic market, for their excess industrial capacity, as their model obviously has been centered around exports and also building out its industrial base. So internally, they're doing that. But the other side of the equation is the reciprocal side of China. What are they going to do in lieu, or in absence, I should say, of any kind of high-level discussion, either a phone call, video call, or a meeting in person between Donald Trump and Xi Jinping? There could be, the big risk is reciprocal tit-for-tat measures. You just mentioned one of them. We're hearing from sources that the NDRC, the top planning body, the National Development and Reform Commission in China, are allegedly telling Chinese corporations not to invest in the United States. This is why we've seen a fairly muted response so far as tit-for-tat retaliation, but China's been saving these levers to use them and roll them out when the tariffs escalate potentially.
All right, Stephen Engle out there in Hong Kong. We'll check in with him a little bit later in the program, but let's go from Asia back to North America. Derek, Decloet joins us right now from our Toronto bureau, and a lot of conflicting messages coming out of Canada. Mark Carney making his case for how he might respond to these tariffs. Canadian Conservative leader Pierre Poilievre, who could potentially actually end up becoming the prime minister at some point, taking a slightly different approach. Derek, what's the word on the ground?
Yeah, and I think you could say that both of those men are taking a different approach from the former Prime Minister, Justin Trudeau. Since this began, under Trudeau back a couple of months ago, the Canadian approach was to retaliate fast and to retaliate hard. So as a result, we have already counter tariffs from the Canadian government on about $60 billion worth of stuff that U.S. companies ship into Canada. Carney has not tipped his hand. In fact, he specifically said, I'm not going to tip my hand on what we're going to do, but he has hinted that he would take a more targeted approach, maybe something that's a little bit more strategic, picking some symbolic items. There will be retaliation coming from Canada, but exactly how far they'll go is a mystery, and I think it's a mystery still to the government in Ottawa, what Trump is going to do. So they have to wait, see what happens at 4 o'clock, absorb that information, and then perhaps come back with something tomorrow. But we expect perhaps a subtler approach than was done under Trudeau only a few weeks ago.
All right, Derek Decloet out there in our Toronto bureau as we check in with our more than 2,000 reporters and analysts across the globe, kicking you off to the close and, of course, to that big 4 p.m. announcement by President Donald Trump. For more on the broader economic impact right here in the U.S., let's bring Esther George into the conversation. Former president and chief executive of the Federal Reserve Bank of Kansas City, was on the FOMC committee for more than a decade. And Esther, there's been a lot of discussion here about the potential economic impact. And I know it's hard to know what that impact will be without knowing what Trump will announce and what the other nations might do in retaliation. As an economist, how do you start that process?
Well, you started a couple of ways, Romaine, and I think looking historically at what tariffs have meant to an economy, and you fast forward to a world today that is far more interconnected and global in terms of its trade. And I think there is really few indicators that suggest this will not be substantial in terms of its impact in a negative way to the economy. Even considering the long run aims that these policymakers have in mind, I think we are in for a bumpy ride, depending on how we see these tariffs unfold, whether they're narrower, whether they are more broadly based. The impact, I think, is going to be felt.
There's been a lot of scuttlebutt in the media speculating on this idea that some of the folks in the White House think that consumers are going to be, and for that matter, businesses are able to absorb the additional costs that these tariffs might bring. When you look at economic conditions as they stand right now, is there enough slack in that area for that to be true?
Well, we've seen the consumer really hold up for some time. But I think the reality is, as we watch consumer sentiment, people are not happy about the prices they are paying already. And the prospect that more will be coming, I think, is sure to have implications for demand in the economy. And we also see this level of anxiety translating into the business community. So whenever uncertainty begins to cause people to pull back for whatever reason, the implications for the economy are that you are probably going to see some reduction in demand, slower growth at a time when we already have elevated inflation. And that's not a good combination.
Esther, we've seen from companies really pressing the pause button. They just don't know what to do, so it's hard to make any actual decisions. How long does a pause for businesses become something more severe?
Well, it's a great question, because I think even in the short run, you are likely to see some impacts, whether it has prompted bringing forward some of their purchases, whether it has caused them to pause. Reading the data, I think, is going to be especially difficult for the next few months to understand what motivations have been behind, what industries have been most affected by this level of uncertainty, which, of course, when you're a business person, you have to make some choices about where you're going to prepare for the future. So I think this is not only a time of uncertainty. I think I hear in the business community and among consumers a level of anxiety that I suspect is going to show up in the indicators of demand for our economy.
And then it sort of trickles, right? Like, is this just pent up demand that you're just delaying it for, say, 6 months, or does it disappear altogether? What does that lag time usually look like in an economy?
Well, it could take a matter of months, absent a shock. I mean, we know when a shock hits the economy, it's felt immediately. If you began to see businesses positioning for whatever assumptions they're making, whatever announcements we hear that bring some kind of clarity, I suspect that you will see some impact. Now, remember, for the U.S., when you look back historically, I heard the mention of Smoot-Hawley. The economy today is much more services oriented than it used to be. So trying to judge the level of impact, well, I think it almost certainly will be felt. Understanding the degree of that will be a function of where these tariffs and this uncertainty really lands.
When we talk about, well, but that also raises the question, Esther, as to what the potential benefit of the tariffs would even be. And without trying to get into the president's mindset here, if the dominance of the service industry on our economy compared to what it was back in 1929-30 when Smoot-Hawley was signed, is there some sense here that maybe the impact won't be as severe?
Well, I think that is hopeful. To think it may not be as severe as it was nearly 100 years ago. But I also think it is not going to be without consequence here. And in fact, you have heard coming out of the administration comments that there is an expectation that there will be an adjustment, that there could be some pain points in doing this. And of course, we don't have the ability to be very surgical, if you will, in terms of understanding where those impacts come. So consumers will be affected, whether it's through prices, whether it's their demand for these goods, and businesses also will be affected, particularly at a time, and remember, we already have elevated inflation. And so this comes at a tricky time for the Fed, too.
I'm going to ask you a kind of a novice question here, and I'm not an economist, which is why I ask. But we tend to split up this idea of the services part of the economy and the manufacturing and goods part of it as well. But there obviously is some interplay between those two, certainly when it comes to consumer confidence and expectations, but even on a more fundamental level. And I'm wondering if you can articulate in a way that a PhD economist can understand that what is that interplay? Like what should we be looking at with regards to how those two things intersect?
Yeah, so I think the first thing you want to watch for is people rely on their incomes to make their choices about what they're going to purchase in the economy. And your level of confidence in the economy, your level of confidence that you will continue to have a job, I think is such a key driver here. So when you see consumer sentiment falling as it is, and people begin to move around less in the job market, which we have also seen in the data, the job market has settled into people hanging on to the positions they have. It suggests that there is a tentativeness in the economy, both on the part of those consumers and businesses. And when you are tentative and hold back on making purchases, you will see this show up in the economy in terms of slower growth, I expect.
Esther, is this a stagflation scenario at this point?
Well, it certainly has a lot of similarities when you see that. And when we think of stagflation, I tend to think of it as being more persistent. So maybe we're seeing early days here. When you see slower growth and higher inflation, that is a combination that meets the definition of stagflation. Whether that will just be temporary or move on is something we'll have to see.
Which is so interesting because if I take a look at the WIRP function on the terminal that shows where traders expect the Fed to be, we're looking at like 71 basis points of cuts this year, totally different from just a few months ago. In general, in a stagflationary environment, can the Fed / should the Fed be cutting?
I think that's going to be difficult for the Fed. I mean, you think about where real rates are. So take out the inflation part relative to where the Fed funds rate is, and you don't have very high real interest rates right now. So the Fed's ability to make adjustments will be a function of whether the economy really weakens and they have to step in. But I think at the current levels of inflation and with upside risk to that inflation, it will be hard for them to plan on making any moves at this stage.
Esther, when it comes to this idea of what sort of mitigation effects can be taken, whether it's on monetary policies, fiscal policy, once we do start to see the effects of these tariffs. How quickly do you think that can work? Because I know we talked a lot, particularly ahead of the Fed's last rate cutting cycle and the rate hiking cycle, this idea of those long lags, that it takes time for those types of things to really kick in and save. And we know fiscal policy could be even longer than that here. So I do wonder, what is the sort of escape hatch for the economy if we do start to see significant pain?
Well, it's a really important question right now, because if you look at both of these fronts, the Federal Reserve has already slowed down considerably the runoff of its balance sheet. And that is a sign, I think, that they are being cautious about how the markets will shake out during this period, not wanting to put too much stress on the Treasury market. The other side of that is looking at fiscal policy. We do not have capacity now, in my view, in fiscal policy that puts us in a very good position to respond to any contingencies like a significant slowdown. And so for that reason, I think, and we look at the path of debt at the federal government level, pressure on the Fed, pressure on interest rates in an upward sense is going to be a very tough dynamic if the economy needs assistance.
Where do you see, I guess, the global economy going? And I mean that in the sense that we've talked a lot about basically, kind of that post-Great Depression, post-World War era, created this sort of globalization, if you will, that to a large part benefited the United States. And the president has made it clear that for a variety of reasons, he thinks we're not necessarily getting the better end of that deal at this point, and he wants to upend that. Are we looking at a complete fraying of that globalization, or will this look more like just kind of tinkering around the edges and maybe just reimagining into something that I guess takes us into, the next 50 years or so?
Yeah, I think it's an excellent point, Romaine, because I think this will be a real test for the global economy, particularly if it escalates and there is retaliation around that. Because the truth is, in the United States, although we have benefited from global trade, we have also seen systematically over the course of decades a shift away from some of the jobs that historically have allowed for people to be in the middle class. And so some of those gaps, I think, have created a sense that there is unfairness and that opportunities have been missed in our workforce. So watching how these dynamics unfold is going to be important for those that depend on this global market for trade, important for domestic workforces and where they find their opportunities. And so the challenges are big.
Huge. Whether
this strategy takes us in the direction of long-term benefits, I think is questionable right now.
Well, okay, fair enough. I mean, you don't have a crystal ball, but if we just sort of pretend the next 5 years don't exist and we get to a place where we have an economy that's more private industry led versus government supported led, what kind of economy does that look like?
Well, I think the private sector in a market-based system like the United States, you want the private sector to flourish, and you do not want government to crowd out that private sector. So the aims to bring our fiscal situation under control, I think, are critical. We know that the path that we're on now is not a good one. We're paying more in interest expense on our debt than we are on defense spending. And so the path ahead will depend enormously on how much discipline we can bring to bear on that fiscal spending that ultimately will avoid crowding out the private investment that we need for long-term growth.
Esther, really appreciate you taking time for us. Esther George, who ran the Kansas City Fed for about 11 years, helping us kick you off to the close and, more importantly, kick you off and count you down to that big announcement by President Trump regarding tariffs. But Alex, there's a lot else going on as well. Remember TikTok? Well, there's a deadline, of course, for some sort of deal to be worked out. And now the Information is reporting that President Trump has a new idea for it. It's called TikTok America. basically a new entity that would be 50% owned by new U.S. investors. Again, this is according to the information, according to people they've spoken to, and they're actually saying that he plans to announce this today.
And that ByteDance would retain about less than 20% stake in the new company, and existing investors would get the remaining third stake, according to the information. But we'll have to see, right? Also, what does TikTok America look like? Does it retain the same technology that TikTok a la ByteDance does, or is this a real stripped-down version, or because ByteDance is involved, you can have both?
Right. Are you getting the brand, or are you also getting the technology behind it? Also, we should just point out as well that China would have to sign off on this as well. The story makes it clear that it's unclear how the Chinese government would actually feel about this particular proposal. A lot to cover here coming out of Washington, and that conversation going on inside the White House today with a man who certainly has some insights into past trade battles. Wilbur Ross, the former Commerce Secretary, he's going to be joining us in a bit, right here on The Close. This is Bloomberg.
All right, quick check-in here on the markets. We are about 45 minutes away from that tariff announcement from the White House. The S&P is up just about 0.2%. You're seeing the outperformance in the Russell and those small cap stocks, but even Mag 7 is getting a little bit of a bid. Gina Martin-Adams, Chief Equity Strategist with Bloomberg Intelligence, joins us now. Gina, will this be a tradable clearing event today?
You know, that is such a hard question. It's the question that we're talking to everybody about, and I don't think that anyone has any real clarity on this. We're kind of in wait-and-see mode. The things that we know are estimate revisions are falling, economic growth is stalling a little bit under the degree of uncertainty, so the best thing that can happen today is certainty. Will we get that certainty or not is still a big question mark. Will the tariffs stick that are announced? Will we have enough meat on the bones of the announcement to really trade it? There's still so much uncertainty out there, and that uncertainty itself is tradable. Will it end? Really, really big question mark that I don't know anybody has the answer.
It's like details versus clarity are actually quite different.
Yes, that's right.
So then to that point, where do you think the biggest vulnerability within the equity market is right now?
Yeah, I think it's still big cap tech.
Really?
Yeah, and this is something that we talk with a lot of clients about, is there is an impression that tariffs will manifest themselves through potential consumer weakness or maybe industrial weakness, because we think of tariffs as, a cost that is paid for by the consumer. And while that's true, the true vulnerabilities are really the corporations that have driven globalization and sort of a multinational perspective for decades, where they've seen margin expansion as a result of their drive to globalize. Now, as we're reversing that globalization trend, these may be the most vulnerable entities of the index. So, for example, within the big cap tech space, 60% of tech's factories are located overseas. So their own internal factories, they're more vulnerable than any other sector. They also have more revenue exposure to overseas economies. So from a revenue line, you've got more potential for retaliatory tariffs to impact these companies. And then even if we isolate their cost of goods sold, 80% of their cost of goods sold comes from outside of the United States. So they're importing product more than anybody else to ultimately sell to their clients. So you've got a ton of vulnerability just in big cap tech that only exacerbates an underlying trend that had already been in play of decelerating earnings growth, a little bit of margin pressure emerging in 2025.
Yeah, and I just want to point out, too, Bloomberg Intelligence overall did a great write-up of all going through every single industry piece by
thank
piece.
you.
I actually use that
I can't take credit for all of that.
I use that to prepare for
but
this
a tiny bit.
But I bring it up because some of the numbers really stuck out at me, and one that I thought was interesting, they were talking about, for example, PC makers.
Right.
90% of that's sourced overseas, but 60% of that's sold in the U.S.
Yep.
And so it raises the question, particularly given that you have to pay attention to corporate fundamentals. We're heading into another earnings season. Do these companies that are set up in that type of supply chain environment, is there any quick fix? I mean, is there any way they can get out from under that in the short term, or is this just they've got to either bite the bullet or hope that their consumers bite the bullet for them?
Yeah, I think they kind of have to bite the bullet, to be honest with you. I think there are some quick fixes to the degree that you have factories with capacity in the United States that you can quickly transition some of the capacity build back onshore to avoid tariffs in the short term. Sure, but I think that is a very, very slim few.
If the companies themselves are biting the bullet, meaning we're going to see weakness, or at least a lower than what the market had expected in terms of bottom line, top line, or whatever in between here. Has that been priced in? Because we did have a big sell-off already,
Right.
whether that was all about tariffs or more about tech valuations, who knows?
Yeah.
But has some of the worst been priced in or not?
We don't think so. So our fair value model would say, at least for the S&P 500, just the largest of the large cap stocks in the U.S., the market is still pricing for 18% earnings growth to emerge over the course of 2025. That is almost impossible. Even in the best of circumstances, you don't usually get that much recovery in earnings growth after a 10% growth year that we had in 2024. So there's still a very robust outlook priced into the equity market. Where we will see the most momentum or the most momentum shift, we think, is actually in margin assumptions, because revenue growth assumptions are not all that robust. And frankly, there's just been this ongoing year by year uncertainty that has held in revenue growth expectations. Where earnings growth is expected to expand fastest is through new margin highs by the end of the year. That's going to be really tough to make if producer prices are accelerating very quickly and the companies cannot pass on that price increase all the way through to the consumer level, which seems unlikely in today's economic construct. So we're likely to see operating margin forecasts start to deteriorate. Interestingly, we're already seeing that for the non-domestic stocks of the world, where even though non-domestic stocks have done a little bit better than domestic stocks this year, non-domestic forecasts for margins have actually already started to deteriorate. Where we have not seen much decline in margin forecasts is in the U.S., unfortunately, which is, again, why we say U.S. is still very vulnerable to tariff risks.
Okay, so let's look at it from a different angle. So if you wrap in what we may see in the economy, Esther George was saying it looks like you could be headed towards the stagflationary scenario. What typically does well and works well in a stagflation environment? Yeah,
so if you think back to 2022 was our most recent year of stagflation risk, where growth was slowing, but inflation was also spiking. That was a very short-term stagflation, but it was at least our most representative year of this. It was obviously a really rough year for stocks at large, but the sectors that worked were the commodity-sensitive segments of the world. The inflation plays, if you will, inside the equity market, like energy and materials, generally did better than the rest. So if we go into some sort of true stagflationary environment, you would anticipate the inflation plays to work a bit better. We started to see a little bit of that with energy performing reasonably well over the course of the last month, at least in comparison to the rest of the index. I would not go so far as to say the market has, by any stretch of the imagination, priced this in, given the relative discount in that space still, particularly compared to big cap tech. But if that really gathers a bit of tailwind, the stagflation trade, I think, would benefit energy most.
Hey, Gina, thanks a lot. We really appreciate it. You're going to be busy come 4 o'clock. Gina Martin-Adams, Chief Equity Strategist with Bloomberg Intelligence. Thank you very much. Well, President Trump's tariffs aim to reduce the U.S. trade deficit by cutting out imports. In a recent piece for Bloomberg Opinion, Shannon O'Neill, Senior Vice President with the Council on Foreign Relations, says the impact on exports could be severe, writing, in a world of global supply chains, boosting exports means upping imports as well. Widespread tariff hikes will also hold back U.S. base exporters. Shannon O'Neill joins us now. Shannon, when we get the announcement coming out in just about half-hour time, what are the line items that are going to be key for you in determining what the big takeaway is?
So I'm going to look at the overall tariff rate, how high these tariffs are going to be. I'm going to look at how many countries are effective, so how broad this is all going to be. I'm also going to look and see what happens if there's particular sectoral tariffs, and if these are additive, i.e. you're adding universal tariffs and sectoral tariffs, or if it's just one big number depending on the country. So I'll be looking at those overall amounts.
And when you take a look at that, what country is going to be the most vulnerable? Where are those cracking points?
Well, there are a lot of cracking points, and we've seen sort of 15 countries laid out as the dirty 15, perhaps, and that's about 85-90% of all U.S. imports. But the countries that will be most effective and, frankly, I think are most important for the United States in terms of our competitiveness of our industries are going to be Mexico and Canada, our two biggest trading partners and our two neighbors.
So when we talk about this idea, Shannon, of whether there could be some sort of negotiated solution, I mean, we haven't heard a whole lot, at least certainly not from official sources. Do you think it's possible that this could be short-lived? I mean, it seems like Mexico's president has made some effort to try to discuss things with Trump and the White House. Canada maybe a little bit less so. And we know Europe has made it clear that they're at least open to negotiations, as is China.
I think anything could happen. That's what we sort of know. There's a lot of volatility, I would say, over these last few months. But we do see a lot of openness from many countries that trade with the United States to coming to some sort of deal. We've seen, as you mentioned, right, Mexico's interested, the European Union's interested. India has lowered some tariffs already, sort of a preemptive offering up, the UK as well. So I think there's a lot of room here from negotiation, at least on the U.S. partner side. And the real question is there room for negotiation with the White House today?
Is there going to be trust in that negotiation, though, Shannon? There's been a lot of talk about, the way that a lot of these policies have been proposed, floated out there, and the idea that it's eroded a certain degree of trust in the United States and, more importantly, the continuity in policy, not necessarily just a dig at Trump himself, but the idea that, okay, if Trump is gone in, 3.5 years, is the next president going to carry through and follow through on whatever agreement that the previous president made?
I think that is a big question here. And it really depends. The other thing I'd be looking for is what kind of tariffs these are, right? There are different rules within the U.S. government, the way you can put tariffs in. And so the executive branch has, all these numbers, 232 and 301 and the Emergency Powers Act. And so depending on which power the Trump administration uses, it will depend on the longevity, really, of some of these tariffs. But the real question here, I think, is, right, that longer term aspect. And why are we putting tariffs in place? And there's a lot of goals that have been said by the Trump administration. There's raising revenue, so replacing, taxes and the like. There is leverage over other countries to get things that we want, like security from Mexico, stopping fentanyl and the like. And then the third is this idea of restructuring the global economy, bringing manufacturing home. And some of those goals are in tension with each other. But even if some of these things stick for 3 or 4 years, what happens next? That's the big question, because none of these, so far at least, are going through Congress. They're not going through legislation, so they won't have that lasting power if you get a new administration that has a very different view of world trade.
Was there an alternative? I mean, when you listen to the president and his grievances and what he says he's trying to solve, do you think there could have been another mechanism other than just blunt tariffs that maybe could have gotten us there?
Well, it really depends what the main goal is. And some of these goals I laid out are in contradiction with one another, right? If you want to raise revenue, then you want tariffs, but lots of imports coming in. So you don't want domestic manufacturing. If you have a lot of domestic manufacturing, then you're by inherently not importing lots of things. So there's lower revenue coming in. So these things don't actually match up with each other. But if you want to create greater economic competitiveness, one way to do it, if you're trying to lower deficits and be more competitive, one way to do it is to increase exports, not just decrease imports, right? This is an equation, and if you raise exports, you have lower deficits, not just reducing imports. And so to increase exports, to make U.S. industries more competitive, not just in U.S. markets to U.S. consumers, but in the 8 billion people that live in other countries and the growing middle class in Asia and Africa and Latin America and other places, you need to have good products at low prices. And the way to do that is to create and hook into global supply chains. And putting lots of tariffs on all kinds of other countries is not the way to do that.
With your expertise on trade, supply chains, and Latin America and Mexico, Shannon, are we going to see the result of other countries getting closer together? Mexico and Canada, for example, Brazil and China, which we saw during the last trade war, Europe and the UK, for example.
We've already started to see other countries go out there and try to form agreements with each other. So the EU is out there negotiating agreements, trade agreements with South American nations, with India, with other nations. You're seeing China go around the world creating other free trade agreements with Asian countries and like. So there's already a rewriting of global trading rules and preferences that the United States has been part of. And you've started to see just in this last week conversations between the Chinese, South Koreans, and Japanese. You're starting to see conversations between Mexico and other countries, Brazil and China, as you just mentioned. So yes, I do think you're going to start seeing other countries decide, sure, we want to sell to U.S. consumers, and maybe we can do that even with tariffs, but we're going to look for other markets that are going to be more attractive to us in the long term that don't have those tariffs. So, yes, short answer is we will see other kinds of relationships form without the United States as part of it.
And do you think, Shannon, that those conversations that are happening now, are they sticky, irrespective of what happen in the next 4 years?
Some some of them I think are, because there's a resilience. We talk a lot about resilience today and supply chains, resilience in your economy. You want to diversify. But in what the United States has done with this threat of tariffs and maybe perhaps in the next half hour, the reality of these tariffs, what they've done is shown that the United States can't always be a reliable economic partner. And I think this is particularly important for countries that have been U.S. allies, have seen themselves as on the same geopolitical side. China, over this last 8 years, has de-risked itself, delinked itself, increased its trade with other countries around the world. In fact, today, China trades more with Southeast Asia than it does with the United States. So they've already started to move their trade. But the European Union, Mexico, Canada, other geopolitical allies of the United States have really tied themselves to the United States. And I think they will be asking questions of their own strategies, and they will be looking to diversify, looking for other trading partners as well as perhaps geopolitical partners.
I'm curious, though, what options are out there? And specifically, I want to just start with Mexico for a second, because I know you spent some time in your life and your career down there, and that is your background, at least in terms of academically. So is the environment there, the political environment, and more importantly, their economic environment, is that conducive for them finding another partner?
So Mexico is the most tied nation to the United States. It will be the hardest for Mexico. One, it's a big trader. A big part of its economy is based on trade. And most of that trade, 80+% of that trade, is with the United States. So they have the hardest road to hoe here in terms of diversifying. But they, too, will look abroad. And, Mexico has free trade agreements with almost 60% of the globe's GDP. They have a baseline there where they can trade all around the world. So I think they will start to look to do so. Though it'll be harder for them than some other nations just because of the sheer, focus of geography and the concentration already with the United States. But other nations, they have started to see trade. In fact, there are dozens of nations that have started to see trade with other nations more than the United States. If you look at the last decade, as they saw their trade grow, it was with other nations rather than the United States. And I would imagine they would double down on those other potential partners. And then finally, I would say, as we look at the global economy and we look at where real growth is going to happen, where the next billion people coming into the middle class are going to come from, it's not going to be the United States. It's going to be Asia, frankly. And so if you are a big company, what are the markets that you're going to see growing over the next 10 to 20 years in terms of their size and their scope? They're going to be in emerging markets. And so you will put resources, you'll put supply chains, you'll put marketers to go after those markets. And that's not going to be here in the United States. If the United States is tied into global supply chains, we could be part of that story. We could provide the machinery or the capital goods or the inputs or the final products. But if we isolate ourselves out with a whole wall of tariffs, then all of that production will likely happen in other places for that next billion middle-class consumers.
Shannon, great insight. Shannon O'Neill over at the Council of Foreign Relations as we continue to drumbeat to the closing bells and to that announcement from the Rose Garden in Washington, D.C., scheduled to take place sometime around the top of the hour, where the president will unveil a list of reciprocal tariffs. And remember, a big part of this is about the idea that, at least in Trump's words, that the U.S. getting the short end of the stick is less about whatever tariffs exist already, but it's also about some of the non-tariff borders and barriers that he says need to be addressed. One of the people who was in the administration, his previous administration, who was tasked with helping to address that is Wilbur Ross. He's the former Secretary of Commerce of the United States, and he joins us right now. Thanks for joining us, Wilbur. I am curious, when you look at what I guess we can just call maybe an expansion of some of the trade policies that Trump had in his first term to now where we are in the second term, we've gone beyond just tariffs themselves. A look at VATs, a look at regulatory regimes, a look at a lot of things overseas that he says are, to some degree or another, limiting the promise of America. Do you think that this latest tact, this latest move forward, is the way to address it?
Well, I think it's certainly one effective way. And I must say, I disagree with a lot of the points that Ms. O'Neill had made. I mean, she talks about the non-U.S. countries doing more trade with each other. Well, the truth is, most of those countries already have trade deficits because of China, and the only reason they're able to afford even their present deficit is their trade surplus with us. So when that goes away, they're not going to have the resources to be doing all this buying from other countries. Second, the argument that somehow running a trade deficit with a country makes them a more reliable ally. There is no empirical evidence that this is true. It certainly didn't work in the case of China. And in the contrast, Australia actually has a negative balance. We have a positive balance with Australia, and they're one of our best allies. So all these theories are very interesting, but they don't correspond to the actual realities.
When you were in the administration and you had a chance to sit down with your counterparts in other nations, did you get the sense that they understood that? I know publicly they might put on a little bit more bravado, but behind the scenes, did they express a sense that because of the dominance of the U.S. economy, that they were in that position that you just laid out?
Well, they would never admit it to me as part of the administration, because that would simply limit their own bargaining power. But the behavior proves that they know it. And what I'm talking about there is that these countries know they cannot afford a trade war with us. They simply cannot. And here's why. Take Canada and Mexico for an example. Those economies are each about 1/10 the size of ours, and each is hugely dependent on trade with us. So the fact that they're 1/10 our size means $1 of trade penalty to them is 10 times as powerful as it is to us. That's a horrible, powerful ratio. And as a result, I don't think they can afford we go up, they go up, we go up, they go up. Mm-hmm. It would totally destroy their economies. I mean, here we're talking about the possibility of some sort of a mild recession. For these countries, you're talking about a serious depression if they really get cut off from the U.S. So I think its proportions are totally different. And you've seen that in the actual behavior of all of them. Mm-hmm. Last time when we put the steel and aluminum tariffs on, no country retaliated in total symmetry to us. They were all milder retaliations. What China has proposed so far is also a milder retaliation. And what EU and Canada and Mexico have been talking about also is very mild compared with what we're doing. Mm-hmm. That to me is the proof that they know they cannot afford a trade war. So they have to speak very bravely, especially in the beginning, for domestic political reasons. But when push comes to shove and they have to decide what are they actually going to do, I don't see this whole big wall of reprisals amounting to that much. Right. So I think it's totally overblown.
But Mr. Secretary, we are seeing, though, people here in the U.S. are freaked out. They're really worried in a way that wasn't there in the first term when you were in the cabinet. Is there a Trump put in the same way that we understood it to be in the first administration?
Well, the difference now is that Trump is much stronger. In the first administration, he didn't have real control of the Republican Party. He was not that popular with the general public, and he certainly didn't have very good control of the Congress. So he was fundamentally weaker. Plus, there's another important factor. In our administration, we were researching what are the limits to presidential power. And as you know, we used some arcane legislation from 1972 and 76 and other unusual ones, and they were tested in the Supreme Court. Well, that took a lot of time, but now with the IEPA and Trump knowing that he has the power to do it. He hasn't needed to have the delay of big, long investigations before he can impose tariffs. Mm-hmm. And that series of factors has given him the strength to use tariffs for multiple purposes.
Right, but if consumer confidence and CEO confidence continues to roll over, if markets continue more volatility, is there the lever where President Trump will say, hold on, I got to back off, or no?
Well, I think what has everybody excited for the moment is the uncertainty as to just what will he do. And I think, quite frankly, the media have made so much out of it and put so many gloom and doom forecasts that a lot of people have gotten frightened, particularly people who don't really understand trade very well. So I believe that if he puts forward at 4 o'clock a sensible sounding thing that average people can understand and that works, that people agree will achieve the purposes, I think you'll see things improve, because for businesses, the worst fear is the fear of the unknown. Yeah. And right now, it's mostly unknowns. In a few minutes, it's going to be knowns.
Yes, we hope so. But I am curious just on that point. I mean, let's take the media out of the equation. Let's say the media went dark tomorrow. Automakers have already said prices are going to have to go up should these tariffs actually take full effect here. So if you're a consumer and you walk onto the lot and you see the car you were looking at last month was 40 grand and now it's, 45 or 50 grand here, you don't need the media to scare you. That's scary, Wilbur.
Well, let's see what they actually do. There was the same talk when we did the steel and aluminum last time. Remember, I had to go on TV with the Campbell soup can.
We all remember.
Yeah. 1 penny's worth of difference. So what are they talking about? That it's going to ruin the sale of soup cans. There's an awful lot of posturing that companies put on in anticipation of trying to modify Trump's behavior. So let's see what he actually does, and let's see what the real world reaction is. Until we do, all this is just theory.
Well, it was good to get your theory on this, Secretary. We'd love to get you back as we kind of get more data and see the actual impact of the economy as well. Wilbur Ross, former U.S. Secretary of Commerce, thank you very much. All right, let's turn back to the markets here. I mean, yeah, you got to rally, but you got to wonder the conviction behind it. You got the NASDAQ up by about 1 percentage point, surprisingly enough, as we head into tariffs about 12 minutes away. I want to bring in Natalia Kniazhevich, Bloomberg's U.S. equity reporter. She follows all the flows and the fund flows and where, like the CTAs, where the volatility funds are all going. What's the band that your sources are looking at right now for what we get at 4 o'clock?
Yeah, so it's interesting that trading desks, in many cases, they disagree with each other, but this time around it looks like a consensus, which is there is more risk to the downside. Of course, it's a math game for many of them, but consensus here is that the biggest concern is that tariff announcement can be open-ended. Yes, on the positive side, it creates room for negotiation, but the market hates uncertainty. And there are different expectations. For example, Bank of America trading desk is saying that the S&P 500 can break below 5,500 level. The most bearish call I found was from UBS trading desk. Michael Romano is saying that if we do have 20% tariff announcement, the S&P 500 can go below 5,400. You guys just spoke about the Trump put. One trading desk said that this Trump put exists below 5,000 level. Wow. Yes, for the S&P 500. So a lot of we do see this rebound, but you have to be very careful how you.
And it's been a volatile rebound. We should also point out volume relatively light than what it would normally be around this time. The VIX is lower, but there's still a lot of volatility in this market. I even saw one estimate saying that traders are expecting a swing of 2 to 3% in either direction, depending on what the president says when it comes to the benchmark index. Do we have any sense as to how people are positioned? Have they moved into certain pockets of the market in anticipation of what we learned at 4 p.m.?
Right, and since you mentioned volatility, we do see something relatively unusual because short-term volatility is now much higher versus long-term volatility. When it comes to positioning, of course, trading desks work hard to create those baskets of stocks. Goldman is saying, yes, you should buy or go long or short on tariff-sensitive baskets. One unusual trade I found. Go short on healthcare companies with exposure to Ireland, because this country has big exposure to pharmaceutical production. Of course, go short on automakers, excluding Tesla, by the way. So lots of like specific pockets of the market, but options trade is also a very big one. And one trading desk also said, if it's time to buy options, this time is now.
Yeah, and absolutely. And I created my own basket of like tariff stocks. I was looking at them today. A lot of them are in the green today. Yeah, I did.
So cool.
A lot of them are up today on the green, but on a year-to-date basis, certainly since you go back to February 14th when the president really started to talk about these reciprocal tariffs. I mean, most of them are down significantly. We're talking about 10, 20, 30%, particularly in autos, particularly in the agriculture space as well. Natalia Kniazhevich, Bloomberg U.S. equities reporter, helping to break down some of the expectations for what trading desks are bracing for later this afternoon. Julie Biel also in the mix. She's chief market strategist over at Kayne, Anderson, Rudnick, and she joins us right now as we count you down to the closing bells, just about 10 minutes away. And Julie, I am curious as to what you actually find attractive in this market, because whether we're talking about tariffs and the economy or, the idea of an AI bubble, and I mean, there are a lot of things sort of battering this market around. And I am curious if there is anything out there that you actually find attractive.
Yeah, there's lots of places that I find really attractive. They're just like not very sexy or, compelling for a lot of investors. The place that I'm really the most focused on right now, because there's so much uncertainty, is I'm really focused on earnings durability. And that is companies that are things like insurance brokers, like a Ryan Specialty, or something like a Copart, where they clearly have a competitive protection that's going to differentiate them, and they're not going to be as whipsawed around by what's going on with tariffs. It's not that hard to find these companies. It's just a function of being willing to roll your sleeves up and look at the fundamentals.
Are you concerned, though, that the fundamentals could break down given the potential impact on the economy from tariffs? And I know that's a hypothetical. As Wilbur Ross said, we're still kind of in the theory stage. But in theory, we're going to find out the real fundamental case probably over the next few weeks.
Yeah, I think that's absolutely true. And the thing is that's really difficult about the situation that we're in is that uncertainty has a lasting effect, right? It's one thing to say we're going to have tariffs and pull them back. People don't necessarily feel that much relief, right? Because they know that if it can be brought on and pulled back really quickly, that it could be put right back on afterwards. So I have a sensation that we are really expecting this to be this announcement and we're all going to have clarity. But I think everyone can still recognize that things have been really whipsawing around really quickly, and more could be down the pipe. So even if it's a good outcome with, say, only reciprocal tariffs and not a universal tariff, I still have the concern that more could happen. And the lack of stability makes it really difficult to plan if you're a business and if you're even a consumer.
Totally. And we were hearing yesterday from Ed Mills talking about how it's sort of details versus clarity, right? Like, we're going to get details in a few minutes' time, but the clarity is something very different. Julie, what's on a shopping list that you're like, okay, this is how I'm going to game the system a little bit. If we get this headline, this stock looks good. This headline, that stock looks good. Are you playing that game?
No, I mean, look, in many cases, I will have whole quarters where I don't do any trades. We're not really reactive to the macro. I mean, I know my title is chief macro strategist, but literally no one on our investment team pays any attention to what I say. And that's just because we don't really have a macro viewpoint. We'd rather find great, brilliant businesses that can adapt. Let them do all the hard work of figuring out the macro. Mm-hmm. And, you have to remember, the level of innovation and dynamism in the U.S. economy and corporate America is quite strong. Their ability to adapt to situations like tariffs last time, it's impressive. So I have a lot of confidence that the businesses that we own are going to be well positioned. But, I think the real question is how does this influence business investment? That's the place that I'm the most concerned about, and employment.
Right. So talk more about the picks where you insulate yourself from all of this.
So one company that I really do like a lot is a company called Decloet. And this is a company that helps shippers with their arranging their shipping and their trading. And so it's a little bit like a Bloomberg terminal for shipping. And so it has both the data and the information that they need in order to process and figure out, okay, I'm going to have tariffs, what's going to happen, what's going on with customs processing. It's a pretty robust suite. And it has a good, strong network effect around it. I think they genuinely tend to benefit when there's as this level of disruption in trade. In the near term, I think there could be some challenges because, again, that uncertainty has a lot of people holding their hands up and saying, I'm just going to wait and see and sit on my hands because I have no idea how to predict things. So I think in the near term, it could have some challenges, but for a long-term investor, it's a nice play.
We're in conversation right now with Julie Biel as we count you down to the closing bells. Those bells right now, just about 5 minutes away. And we're also awaiting that announcement from President Trump. That is a live shot of the Rose Garden at the White House in Washington, D.C. Folks gathered there to see what the president has to say, and more importantly, to really get into the nitty-gritty, the details of exactly what these reciprocal tariffs will look like. So as we kind of talk, Julie, here about the economic impact and market impact of what those details might actually be, I am curious as to whether you see value in companies that have outsized international exposure. Earlier this year, we were talking with a lot of strategists, and they were saying, look, domestic manufacturers or domestic companies that don't necessarily need to depend on anything going across the border.
Yeah, I think for sure the knee-jerk reaction is, hey, you should be buying small cap companies because they have less international exposure. And that's kind of true, but broadly not 100% true. You really have to look at them case by case. You know, they are going to be beneficiaries of the tariffs for sure, but for the most part, it's a function of understanding how this changes cost structures. And, you know, the complexity that we have is that a lot of our global supply chains, they're not just going one way, right? You have parts that are going back and forth over certain geographical boundaries, and that creates a lot of tension and misunderstandings of where should we best allocate our resources. I do think that you can have specialized producers in the U.S. that are differentiated, like an Enerpac, where they have really highly specialized industrial machinery. That's the type of business that I think is more compelling to me right now than one where I'm having to guess exactly how tariffs are going to ripple through their cost structure.
Right, Julie, and as you mentioned, you're a macro strategist, but you may not make a big macro trade for like a whole year, right? You're doing it for the long term. What's been the biggest surprise for you within the market, or the biggest headline that has you scratching your head right now?
You know, I think what had me scratching my head in the very beginning of the year was the level of enthusiasm around this administration. I agree that regulation is an opportunity for us to become a more efficient market, and there are real places there. But I think the euphoria around that and AI at the same time, it really felt like, okay, but like, where's the beef? And, you know, now we're starting to recognize, okay, we're not actually 100% sure where this beef is. And I think this idea that tariffs could be really damaging long term is really starting to take hold. And so, you know, I certainly didn't position with the hopes that there was going to be any kind of tariff and that they were going to escalate to the point that they have. But here I am sitting, as a lot of active managers are, outperforming their benchmarks. And I think it's a function of not being overly levered to any specific outcome.
Julie, appreciate you taking time for us. Julie Biel, she's Chief Market Strategist over at Kayne, Anderson, Rudnick. The shot on your screen, that is a live shot of the White House, the Rose Garden to be specific, where we are expecting to hear from the president in minutes to announce the details of those reciprocal tariffs that he has been promising effectively since he was inaugurated back on January 20th. The market's moving all around here on this day as people try to assess what the impact of those tariffs will be on the markets and on the economy. Vincent Reinhart joins us right now. He's the chief economist at BNY Investments, and prior to that, spent about 20 years at the Federal Reserve in a variety of positions. All right, Vince, I mean, you know, we were speaking with Wilbur Ross earlier, and he kind of talked about this idea that anyone trying to sort of talk about the economic impact of things right now, this is all theory, and I get that. However, there is some historical precedent for these types of protectionist measures, and I'm wondering if there's anything that can be gleaned from past trade squabbles to today's environment and today's economy.
I would argue it's just a wonderful application of theory. And so we should be able to find some hints of what could happen in our history. Basically, we're going back to the 90s, 1890s, that is. That's the last time the tariffs were probably as high as they're probably going to be. The aspirations of the White House to make tariff duty revenue a significant source of U.S. federal revenue, that's the 1890s. Industry was concentrated. We had higher tariffs than our trading partners. I think the big difference is manufacturing was extremely concentrated. You could manage the U.S. economy as long as you had a few people in the room, if those people were John Rockefeller, Morgan, Andrew Carnegie. We're not there anymore, and it is a lot of complicated trading patterns. Nobody really has market control, in which case we're doing this real-time, large-scale experiment with a working mechanism.
Hold that thought, Vincent. We're in conversation right now with Vince Reinhart over at BNY. We are getting the closing bells here in New York. Green across the screen, Alex Steele, in a very volatile session. We were down by 1% on the S&P, higher by 1% on the S&P, ending the day on the S&P right now up by 0.7%. A big rally in small caps. The Russell 2000 up about 1.7% to end out the day.
Yeah, go figure. If you're going to see tariffs, you would think the Russell would get hit and be the most vulnerable, or those mid caps. Not the case in terms of the price action today. Yields, though, go pretty much nowhere. Not that safe haven buying. Gold, though, managing to close up around here by about $18, at one point hitting yet another record high. So there still is that little bit of safe haven bid, and you have to wonder, is it going to be a buy the news, sell the rally kind of thing, or is it sell the rally, buy the news, or all that stuff?
We should point out that volume in both the equity and the bond market was a touch lighter than what it would normally be. A lot of traders we've talked to say really keep an eye over the next few hours on what's going on in the FX space. The dollar slightly weaker here to end out the day. Bitcoin higher by about 2%, up around that 87,000 level. Vincent Reinhart is still with us, the chief economist at BNY Investments, and former worked at the Federal Reserve. And Vince, on your last point, as you were talking about kind of us being a manufacturing economy back in the day, a much more concentrated manufacturing economy, I am curious about the weight of the services industry and whether that could maybe blunt the potential impact, the negative impact of these tariffs.
So it certainly will. 30% of the CPI basket is on goods, 70% is on services. So when you talk about the pass-through of imports to household and imports are where we'll see the effects of tariffs, it's going to be a fractional because of that. However, services do use some imported inputs. You drive around in your car, there will be some extra expenses. So it will bleed through to the greater economy, but services are definitely a cushioning device. They also, however, are the next frontier for fighting. We have a positive service balance. We have an enormous trade deficit in goods, but by and large, we export more services than we import. If our trading competitors run out of room to retaliate, they may start looking at services.
We're all looking at a live shot right now of the Rose Garden. This is President Trump's first Rose Garden event during his second term there. Several of Trump officials have already entered the area. Vincent, when we talk about the sentiment, and we take a look at the manufacturing versus services economy, sentiment just stinks on the CEO level or on the consumer level. How long until that translates into the hard data, or does it?
So a couple points. The first is today we're going to get details. We're not going to get certainty. Are you sure the White House won't change its mind if the economy were to act poorly or the markets receive it poorly? Are you sure the courts are going to sign off on all aspects of this, particularly when they're pushing on new frontiers in the application of trade policy? So we'll get details. We're not going to get certainty. What does that mean? It means the most attractive option right now is the one that says you can wait before you make a commitment. The waiting value of delay is just way more attractive right now in markets, and that's going to be a problem for the economy. Yeah. If you have an opportunity to delay until decisions become clearer, you probably will take it. Soft data are more erratic, and I do worry now that anytime we take a survey, we're really just litigating the election one more time. And so that the political economy is contaminating our understanding of the macroeconomy. However, Soft data usually shows up ultimately in hard data. It hasn't yet.
No, it hasn't yet. Also, inflation expectations have been relatively tame, despite the fact the sentiment survey has come in pretty grim. What's the number one question that clients are asking you most right now? What's the most clarity that they want?
So part of it is how much do you think tariffs will pass through the prices? And what will the Fed do about that? That's the second round question. The other question is, and how big a tail risk is there? What probability do you put on recession? And the fact is, everybody is putting more probability of recession, although I will admit economists don't have a whole lot of credibility in calling a recession.
In conversation right now with Vincent Reinhart, chief economist at BNY. You can see there on the other side of your screen there a shot of the Rose Garden. Just for our viewers, we're going to have special coverage going all the way through Balance of Power, which starts at 5 p.m., going all the way to 7 p.m. Also, if you're on the Bloomberg terminal, we have a live blog that is up and running. Some great details here about who's actually at that event. Howard Rudnick is there, apparently holding a poster, Alex Steele. We're also learning from the live blog that Vice President J.D. Vance is also working the crowd there. And of course, we're still waiting to see the big man himself, President Donald Trump. We are waiting for it. Treasury Secretary Scott Bessent is also there as well chatting. So we'll, of course, bring that to you live as it happens. So, Vince, I am curious. I know it's going to take some time, and we focus a lot on the U.S., on what the White House is doing. There's still a big question about the retaliation by Mexico, Canada, Europe, China, et cetera. I think we're having a little issues with Vince's connection. But, Alex, it gets to this idea that at some point, this conversation is going to shift away from what the White House is doing and what the other capitals around the world are going to do in return. Yep. It looks like we may have the president walking out in just moments right now. You were looking to President Trump walking out into the Rose Garden. There he is now, shaking hands. And, of course, we are really waiting to hear exactly what the details. We kind of know the countries that are in his crosshairs. We have a general sense of what the scale of these tariffs and these protectionist measures will look like. What we don't have are the actual individual details. And that's really going to drive not only the market response, but the economic response as well.
Thank you. Nice crowd. What a good-looking group of people. Well, we have some very, very good news today, and a lot of good things are happening for our country. Please sit down. My fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy. For decades, our country has been looted, pillaged, raped, and plundered by nations near and far, both friend and foe alike. American steelworkers, auto workers, farmers, and skilled craftsmen, we have a lot of them here with us today. They really suffered gravely. They watched in anguish as foreign leaders have stolen our jobs, foreign cheaters have ransacked our factories, and foreign scavengers have torn apart our once beautiful American dream. We had an American dream that you don't hear so much about. You did 4 years ago, and you are now, but you don't too often, and for many years and decades even, you didn't hear too much about. Our country and its taxpayers have been ripped off for more than 50 years, but it is not going to happen anymore. It's not going to happen. In a few moments, I will sign a historic executive order instituting reciprocal tariffs on countries throughout the world. Reciprocal, that means they do it to us and we do it to them. Very simple. Can't get any simpler than that. This is one of the most important days, in my opinion, in American history. It's our declaration of economic independence. For years, hardworking American citizens were forced to sit on the sidelines as other nations got rich and powerful, much of it at our expense. But now it's our turn to prosper, and in so doing, use trillions and trillions of dollars to reduce our taxes and pay down our national debt, and it'll all happen very quickly. With today's action, we are finally going to be able to make America great again, greater than ever before. Jobs and factories will come roaring back into our country, and you see it happening already. We will supercharge our domestic industrial base. We will pry open foreign markets and break down foreign trade barriers. And ultimately, more production at home will mean stronger competition and lower prices for consumers. This will be indeed the golden age of America. It's coming back. We're going to come back very strongly. We're pleased to be joined on this momentous occasion by Vice President J.D. Vance. J.D., thank you. Thank you. Thank you very much. Where are you, J.D.? No, that wasn't too hard to find. I was looking, you know, he likes to take a low-key attitude, so usually we sit right in front. He's gaining a lot of confidence, Mike, isn't he? And nearly my entire cabinet is here, as well as Speaker Mike Johnson, who's done an amazing job. And with the great success we had last night in Florida, we have a majority of 7. And 7's like a lot when we had it at 1, right? You've done a fantastic job. And many of the members of the House and Senate are with us. Senators, congressmen, thank you all for being with us. We appreciate it. For decades, the United States slashed our trade barriers on other countries, while those nations placed massive tariffs on our products and created outrageous non-monetary barriers to decimate our industries. And in many cases, the non-monetary barriers were worse than the monetary ones. They manipulated their currencies, subsidized their exports, stole our intellectual property, imposed exorbitant VAT taxes to disadvantage our products, adopted unfair rules and technical standards, and created filthy pollution havens. They were absolutely filthy, but they always came to us and they said, we're violating, we should pay for it. It's all detailed in a very big report by the U.S. Trade Representative on foreign trade barriers, and I'll just hold it up for you. It's available, and you don't have to pay too much. As I understand it, you'll pay nothing. It's a lot of work for something, actually, because it's a special book. It's very, frankly, it's very upsetting when you read it, when you see what people have been doing to us for 30 years. This all happened with no response from the United States of America, none whatsoever. But those days are over. Let me offer just a few examples of the vicious attacks our workers have faced for so many years. The United States charges other countries only a 2.4 tariff on motorcycles. Meanwhile, Thailand and others are charging much higher prices, like 60%. India charges 70%. Vietnam charges 75%, and others are even higher than that. Likewise, until today, the United States has for decades charged a 2.5 tariff. Think of that, 2.5% on foreign-made automobiles. The European Union charges us more than 10% tariffs, and they have 20% VATs, much, much higher. India charges 70%, and perhaps worst of all are the non-monetary restrictions imposed by South Korea, Japan, and very many other nations. As a result of these colossal trade barriers, 81% of the cars in South Korea are made in South Korea. 94% of the cars in Japan are made in Japan. Toyota sells 1 million foreign-made automobiles into the United States, and General Motors sells almost none. Ford sells very little. None of our companies are allowed to go into other countries. And I say that, friend and foe. And in many cases, the friend is worse than the foe in terms of trade. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen. And they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles. Thank you. Brian, I'd like to have you come up here for a second, okay? I just see him sitting. He's been a fan of ours, and he understands this business a lot better than the economists, a lot better than anybody. Brian, say a few words, please, would you? Thank you, Mr. Thank you. It's a great honor to have you. Thanks.
Thank you, Mr. President. I grew up just north of Detroit, Michigan, in Macomb County, known as the home of the Reagan Democrats. My first vote for president was for Ronald Reagan. I thought that was going to be the best president I ever saw in my lifetime until Donald J. Trump came along. I have watched my entire life, I have watched plant after plant after plant in Detroit and in the metro Detroit area close. There are now plants sitting idle. There are now plants that are underutilized, and Donald Trump's policies are going to bring product back into those underutilized plants. There's going to be new investment. There's going to be new plants built. And the UAW members, and I brought 20 of them with me, they're sitting right over here. We support Donald Trump's policies on tariffs 100%. So, Mr. President, we can't thank you enough. And in 6 months or a year, we're going to begin to see the benefits. I can't wait to see what's happening 3 or 4 years down the road. Thank you, Mr. President.
What a great guy. He got it right from the beginning. He got it before almost anybody else. This group over there, they got it too. And you know, we won the state of Michigan. We won almost all of them, but we won Michigan by a lot, and I want to just thank you all. The auto workers were fantastic. The Teamsters were fantastic. Everyone was pretty good, I will tell you. Thank you very much. I appreciate it. You're going to be very happy very soon, and you probably see what's happening with all of the, not only car companies, but car companies in particular. See it with all of the ones they're moving, they're announcing day in, day out. You're seeing it. Nobody's ever seen anything like that. With today's actions, we're also standing up for our great farmers and ranchers who are brutalized by nations all over the world. Brutalized. Canada, by the way, imposes a 250 to 300% tariff on many of our dairy products. They do the first can of milk. They do the first little carton of milk at a very low price, but after that it gets bad, and then it gets up to 275, 300%. So when they're figuring what's Canada charging, they say, oh, about 2%, 3%. But take a look at what happens down the road. When you look a little bit, it's not a pretty picture, and we don't like it, and it's not fair. It's not fair to our farmers. It's not fair to our country. And with countries like Canada, you know, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say you got to work for yourselves, and you got to? This is why we have the big deficits. This is why we have that amount of debt that's been placed on our heads over the last number of years, and we're really not taking it anymore. Through non-tariff barriers, the European Union bans imports of most American poultry. You understand? They say, we want to send you our cars, we want to send you everything, but we're not going to take anything that you have. Australia bans, and they're wonderful people and wonderful everything, but they ban American beef, yet we imported $3 billion of Australian beef from them just last year alone. They won't take any of our beef. They don't want it because they don't want it to affect their farmers. And you know what? I don't blame them, but we're doing the same thing right now, starting about midnight tonight, I would say. And China charges American rice farmers an overquota, it's called, a tariff rate of 65%. South Korea charges 50%. Actually, they charge different, from 50% to 513%. And Japan, our friend, charges us 700%. But that's because they don't want us selling rice and other things. Who can blame them, Madam Secretary? Agriculture, great job you did on eggs, by the way. The egg prices came down 50%. You got them down 50%. Once we got involved, they were going through the sky. The egg prices, they were going through the sky, and you did a fantastic job. Now we have lots of eggs, and they're much cheaper, down about 59% now, and they're going down further. We charge 2.8% for so many things that other countries are charging 200%, 300%, and 400% for. If imposing tariffs and protective barriers made nations poor, then every country on earth would be racing to eliminate these policies, and China would be the first on line. They run a very strong country, but they're not first in line, and the American people are paying a very big price. From 1789 to 1913, we were a tariff-backed nation, and the United States was proportionately the wealthiest it has ever been. So wealthy, in fact, that in the 1880s, they established a commission to decide what they were going to do with the vast sums of money they were collecting. We were collecting so much money so fast, we didn't know what to do with it. Isn't that a nice problem to have? What do you think, Marco? Good problem? Marco would love that problem. But we don't have that problem anymore, but we're not going to have it very much longer, I will tell you. But they collected so much money, they actually formed a commission to determine what they were going to do with the money, who they were going to give it to, and how much. Then in 1913, for reasons unknown to mankind, they established the income tax so that citizens, rather than foreign countries, would start paying the money necessary to run our government. Then in 1929, it all came to a very abrupt end with the Great Depression, and it would have never happened if they had stayed with the tariff policy. It would have been a much different story. They tried to bring back tariffs to save our country, but it was gone. It was gone. It was too late. Nothing could have been done. It took years and years to get out of that depression, far longer than even FDR had that office right over there for a long period of time. The ramp system, that's rather intricate, was built because of him, and every time you walk up, you think of him, and he did a great job in many ways, but it lasted long beyond his terms, as you know. But it's not too late any longer, and we're going to start being smart, and we're going to start being very wealthy again. We're going to be wealthy as a country because they've taken so much of our wealth away from us. We're not going to let that happen. We truly can be very wealthy. We can be so much wealthier than any country. It's not even believable, but we're getting smart. Nearly a century later, in the face of unrelenting economic warfare, the United States can no longer continue with a policy of unilateral economic surrender. We cannot pay the deficits of Canada, Mexico, and so many other countries. We used to do it. We can't do it anymore. We take care of countries all over the world. We pay for their military. We pay for everything they have to pay, and then when you want to cut back a little bit, they get upset that you're not taking care of them any longer. But we have to take care of our people, and we're going to take care of our people first, and I'm sorry to say that. And today we're standing up for the American worker, and we are finally putting America first. In Sleepy Joe Biden's last year in office, the United States hemorrhaged 100,000 manufacturing jobs, and the number was going through the roof at levels never seen before. And our trade deficit reached a record $1.2 trillion, which is unheard of. Since the beginning of NAFTA, the worst trade deal ever made, it was a horror show. I was able to terminate it. They all said you'd never be able to get it out. We had to get approval from Congress to get it terminated. We had to live with that deal. It was the worst trade deal ever made by far. But since the very beginning of NAFTA, our country lost 90,000 factories. Think of what that is, 90,000. Think about putting a map up and putting tax on it. You wouldn't have enough room. 90,000. I said, is that possible? We had it checked 4 different times, and it was actually somewhat higher than that. And 5 million manufacturing jobs were lost while racking up trade deficits of $19 trillion. That was the worst trade deal ever made. As a result of these gigantic losses, foreign nations now own $26 trillion more of American assets than think of this, than the Americans own of their own foreign assets or other foreign assets. The United States can no longer produce enough antibiotics to treat our sick. We have a tremendous problem. We have to go to foreign countries to treat our sick. If anything ever happened from a war standpoint, we wouldn't be able to do it. We import virtually all of our computers, phones, televisions, and electronics. We used to dominate the field, and now we import it all from different countries. A single shipyard in China now produces more ships every year than all of the American shipyards combined. Think of that. And it was a business that we used to dominate. We used to dominate it totally. In short, chronic trade deficits are no longer merely an economic problem. They're a national emergency that threatens our security and our very way of life. It's a very great threat to our country. And for these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. You're not so kind when you got ripped off with your salaries. My auto worker friends and my Teamster friends and all of the unions that typically voted Democrat, they're not voting Democrat anymore because worker, whether union or non-worker, they're for the Republicans now. That's what happened. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. I'd like to see the chart if you have it. Could you bring it up, Howard? This is our great Secretary of Commerce, Howard Rudnick. Thanks, Howard. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. So 67%, I think you can, for the most part, see it. Those with good eyes, with bad eyes. We didn't want to bring, it's very windy out here. We didn't want to bring out the big charts because it had no chance of standing. Fortunately, we came armed with a little smaller chart. So it's 67%, so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be because we never charge anybody anything, but now we're going to charge. European Union, they're very tough, very, very tough traders. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%, so we're charging them essentially half. Vietnam, great negotiators, great people. They like me, I like them. The problem is they charge us 90%. We're going to charge them 46% tariff. Taiwan, where they took all of our computer chips and semiconductors. We used to be the king, right? We were everything. We had all of it. Now we have almost none of it, except the biggest company is coming in. We're going to end up with almost 40%. Lee Zeldin's working to get their approvals. And it's an amazing company. Mr. Wei, of one of the great companies of the world, actually. They're coming in from Taiwan, and they're going to build one of the biggest plants in the world, maybe the biggest for that. But 64%, we're going to charge them 32%. Japan, very, very tough, great people. And again, I don't blame the people for doing it. I think they're very smart in doing it. I blame the people that sat right in that Oval Office, right over there, right behind the Resolute desk or whichever desk they chose. Japan, 46%. They would charge us 46%, and much higher for certain items like cars, you know, little items like cars. 46%, we're charging them 24%. India, very, very tough, very, very tough. The Prime Minister just left, and he's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades, and it was only 7 years ago when I came in, we started with China and charged them. We took in hundreds of billions of dollars from China in tariffs, and they understood, honestly. President Xi understood. He said, look, I understand, and the other countries, and they all understand. We're going to have to go through a little tough love, maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo was Shinzo Abe. He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. He said, I know that. I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left on the deal that was made previous to my getting there, but it was something. If you look at Switzerland, 61% to 31%, Indonesia, Malaysia, Cambodia, oh, look at Cambodia, 97%. We're going to bring it down to 49. They made a fortune with the United States of America. United Kingdom, 10%, and we'll go 10%. So we'll do the same thing. South Africa, 60%, 30%, and they've got some bad things going on in South Africa. You know, we're paying them billions of dollars, and we cut the funding because a lot of bad things are happening in South Africa. The fake news ought to be looking at it. They don't want to report it. Brazil, 10%, 10%. Bangladesh is 74%. So you see what's going on. Pakistan, 58%. Sri Lanka, 88%. So what we're doing is we're taking not the full, we could take the full 88%. Thanks a lot, Art. He's doing a very good job. How's he doing, all right? I think you better take it with you. It's not going to last very long. He's going to put it, it's going to follow you down with the wind. I brought a hat just in case it got too windy, but here, would anybody like a hat? I'm not giving it to a cabinet. I'm giving it to the auto workers. Come here. Thank you, fellas. Get it. That's it. That's it. They deserve it more than our cabinet. Our cabinet has plenty of hats. But you see the numbers. The numbers are so disproportionate. They're so unfair. At the same time, we will establish a minimum baseline tariff of 10%. You notice that on the chart. And that'll be on other countries to help rebuild our economy and to prevent cheating. So we're going to have a minimum of cheating, and we're going to be very severe on the people that at the gate that watch the tariffs and watch the product coming in, because there's been a lot of bad things happening at the gate because the money is so enormous that you're talking about. There's never been probably anything like it in terms of the enormity, and there are a lot of bad things happen at the people that do the check-in, and they're looking at 10-year jail sentences if they do play. We're going to treat them so good, but if they cheat, the repercussions are going to be extremely strong. Foreign nations will finally be asked to pay for the privilege of access to our market, the biggest market in the world. We're right now the biggest market in the world. We had a great country 4 years ago in terms of the economics. We were doubling up on China. We were doing so well. Nobody was going to catch us, but so much of it slipped away over the last 4 years under Biden. I campaigned on this policy throughout last year, and today that promise was made, and it was also a promise, as you know, that was kept. Promises made, promises kept. To any company that objects to our common sense reciprocal tariffs, again, reciprocal, back and forth, back and forth. And I call this kind reciprocal. This is not full reciprocal. This is kind reciprocal. But what we do is we cut it in half. We charge them. My answer is very simple if they complain. If you want your tariff rate to be zero, then you build your product right here in America, because there is no tariff if you build your plant, your product in America. And we've seen companies coming in like we've never seen before. Likewise to all of the foreign presidents, prime ministers, kings, queens, ambassadors, and everyone else who will soon be calling to ask for exemptions from these tariffs. I say, terminate your own tariffs, drop your barriers, don't manipulate your currencies. They manipulate their currencies like nobody can even believe, which is a bad, bad thing and very devastating to us, and start buying tens of billions of dollars of American goods. Tariffs give our country protection against those that would do us economic harm, and many people were looking to do us economic harm. Maybe not so obviously, but they were doing tremendous economic harm. But even more importantly, they will give us growth. These tariffs are going to give us growth like you haven't seen before. And it'll be something very special to watch. I am so looking forward. And Brian, it's going to happen even faster than you said. You know, you might say, but it's already started. It's already started. Work's already begun on plants all around the country. And you see that as before. These are big, rich companies. We have $61 billion started on a big plant going up. It's going to be announced over the next 2 days, and they already started work. Many of these the biggest companies in the world, they've committed to build, build, build. We're going to build, 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 sir. And they came here to see me, and they wanted to know if they could have a press conference. I do as many as I can. I'm pretty busy trying to stop Russia and Ukraine and the Middle East. We got to stop that. We got to stop the Houthis, which we're making tremendous. They like shooting ships down and out of the water, sinking ships. They get a kick out of it, but they're not getting such a kick out of it now, are they, Mr. Secretary? They're not getting such a kick out of that now. But here are just a short list of some of the companies that have already announced and committed to investment. And this is a company that built its factories and its plants in China. Apple is going to spend $500 billion. They never spent money like that here. They're going to build their plants here. SoftBank, OpenAI, and Oracle, great companies, are investing $500 billion almost immediately. NVIDIA, a hot company, is investing hundreds of billions of dollars. They just announced. TSMC, the biggest, most important company in the world of chips from Taiwan, with no investment from us, is investing $200 billion. And they said the reason was, number one, the election of November 5th, and number two, the tariffs. They don't want to pay the tariffs, and the way they're not paying it is to build their plant here. So we're going to go from almost no percentage. We used to have 100% of the chip market. Now it's all in Taiwan. Almost all of it's in Taiwan, a couple of other countries, but mostly in Taiwan. And think of it, we had 100%. We lost it because of people in that office that didn't do their job. They allowed it to be stolen from us. Johnson & Johnson, great company, $55 billion. Eli Lilly, $27 billion. Meta is investing $500 billion. Wow. DeMac is investing $20 billion. CMA, CGM, $20 billion. And then you have Merck and Clarios, Stellantis, General Motors, GE Aerospace, Honda, Nissan, Hyundai are all putting in billions and billions of dollars, and they're committed 100%. So. And we've never had, and this is after 2.5 months. This is after just a short, this all took place as soon as we came out with what everybody wanted to do. You know, I watched a gentleman today on television. He used to work with Lee Iacocca, a very respected automobile person, and he said, you know, because they're asking people, they try and get as many negative people as they can, but they can't find them too much. It's pretty hard to find in terms of what we're doing, especially when they see all this investment. They said, so tell me, what do you think of what Trump is doing from the automobile standpoint? He said, I can't believe it. Somebody is finally, he's an older guy, real pro, really top guy, with Lee Iacocca. He said, I never thought I'd see the day when this would happen, where somebody had the courage to go and do what has to be done. This is transforming our nation. Our entire nation is going to be transformed, not only with the cars, but on every single other item that's built. We're going to become an industrial powerhouse. And he said that so beautifully today. In fact, I'm going to find out, I'm going to get a tape, and Bruce, I'm going to get that tape, and I'm going to send it to you out in Long Island, and you're going to play it for the people. And all your union workers and your non-union workers out there, you got a pretty even split. But we have, so far, it looks like we're going to have about $6 trillion of investments, and you wouldn't do that in years in this country over the last number of years. $6 trillion, and that's going to be much higher by the end of the year. And think of what $6 trillion is. You wouldn't have even a small percentage of that under this other system. We're going to be an entirely different country, and it's going to be fantastic for the workers. It's going to be fantastic for everyone. There will never have been a transformation of a country like the transformation that's already happening in the United States of America. It's an incredible thing to watch, and it's incredible to meet with the top people, people that you read about, very wealthy people or people that are great managers and executives and presidents of big public companies, and to watch the enthusiasm they have now that they didn't have. They gave up on our country. They went to foreign countries and they built. Companies are pouring into our country at levels never seen before with jobs and money to follow, and it's really beautiful. In the coming days, there will be complaints from the globalists and the outsourcers and special interests and the fake news. Always, the fake news will always complain. But never forget, every prediction our opponents made about trade for the last 30 years has been proven totally wrong. They were wrong about NAFTA. They were wrong about China. They were wrong about the Trans-Pacific Partnership, which would have been a disaster if I didn't terminate it. If I didn't terminate that, United Auto Workers, you would have had no jobs in this country. You would have had no jobs. It was all going to other countries. In my first term, they said tariffs would crash the economy. Instead, we built the greatest economy in the history of the world. And again, I have great respect for President Xi of China, great respect for China, but they were taking tremendous advantage of us, and I commend them for that. I say, hey, if you can get away with it, that's okay. But, you know, they understand exactly what's happening, and they probably, most of them are saying it's about time they did something, but, and they're going to fight, and they're going to fight fair. Everyone's going to fight. You know, it's like, I say to the leaders, look, you got to take care of your country, but we have to start taking care of our country now. We can't do what we've been doing for the last 50 years. From the day of my election, the stock market went up in my first term 88%, with NASDAQ going up 155%, more than any president has ever had in any term in office, by far. And I think we're going to blow that away. And maybe the numbers won't show, but I think they're going to show much better than even those numbers. But what you're going to see is you're going to see activity, that empty, dead sites, factories that are falling down. Those factories will be knocked down, and they're going to have brand new factories built in their place. They're not only talking about renovating, they're talking about brand new, the best anywhere in the world, the biggest anywhere in the world. I have a friend who builds car plants, and I said, I want to see the biggest and the best. He said, well, we have to go to Mexico. I said, no, I want to see it in the United States. He said, we're not building them in there. This is a year and a half ago during the campaign. He said, we're not building it. You'd have to go to Mexico. When I was starting to decide to run, and I went to #1 in the polls very rapidly, I want to say, like, let's say in the first hour. And then shortly thereafter, it looked like I was going to win, and the fake news was saying, oh, no, don't do this. What they don't know is if I didn't win, they would have really been in trouble, because nobody wants to read them anyway. But I tell you what, when it looked like I was going to win, I announced that I was going to be doing exactly what we're talking about today. Great consistency, actually, because I've been talking about it for 40 years. But because I saw what was happening 40 years ago. If you look at my old speeches when I was young, very handsome. My old speeches, and that people would say I'd be on a television show, I'd be talking about how we were being ripped off by these countries. I mean, nothing changes very much. The only thing that changed were the countries, but nothing really changes. But it's why it's such an honor. It's such an honor to be finally able to do this. If you look at China, I took in hundreds of billions of dollars in my term. Hundreds of billions. They never paid 10 cents to any other president, and yet they paid hundreds of billions, so much so that Biden couldn't do anything. They wanted to try and terminate it because he had a very special relationship with China. You know what the relationship was? He had a special relationship. But the numbers were so big, that they couldn't do it. So they did ease it up. They did things that they shouldn't have done. They made it a lot more comfortable for them, but they couldn't do it because the numbers were hundreds of billions of dollars, and I did that. And we were on our way to doing something like incredible. And then we had a very bad election happen, a very bad election. A lot of bad things happened. So when I said we got to do it again, I said we have to make it too big to rig. And we made it too big to rig, and we won in records, and it was a monumental win. And it was such an honor to see so many of you, like Brian and your friends, here with us to celebrate and to, more importantly, celebrate what we're doing, because that wouldn't be a full celebration if we didn't do this, because this will be an entirely different country in a short period of time. It'll be something the whole world will be talking about it. The critics made the very tired predictions earlier this year, but in February, core inflation dropped to the lowest rate in 4 years. And the price of eggs, as you know, just in a month and a half, we were there for 4 weeks. And the first week, I got blamed for eggs. I said, I just got here. They said eggs have gone up at like 250% and you can't get eggs. And they were going crazy. And I said, I just got here. And then we got to work on eggs, and we got to work on everything. And our great Secretary of Agriculture, you did a fantastic job. Brooke Rollins, she did a fantastic job. And as I said before, the price of eggs dropped now 59%, and they're going down more, and the availability is fantastic. They were saying that for Easter, please don't use eggs. Could you use plastic eggs? I said, we don't want to do that. We want to, and you really came through. It's an amazing job. Thank you very much, Brooke. You did great. But likewise, an old-fashioned term that we use, groceries. I used it in the campaign. It's such an old-fashioned term, but a beautiful term, groceries. It sort of says a bag with different things in it. Groceries went through the roof, and I campaigned on that. I talked about the word groceries for a lot, and energy costs now are down, groceries are down, gasoline is way under $3, and people are beginning to be able to buy things and live again. We brought prices way down. We created 10,000 already in a few weeks, new manufacturing jobs. And it was that took place in 1 month, numbers that they haven't seen in a long time. We had virtually no inflation under my term. We had virtually no inflation for 4 years, but after transitioning over to Sleepy Joe, it went from almost non-existent to the highest in the history of our country. They had the highest inflation in the history of our country, brought up by energy and bad spending and bad policy, and a lot of bad things happened. How about allowing millions and millions and millions of people to pour into our country with open borders, where it's so sad to see even now. And I see our great secretary you have done. Stand up, please, Christy. Stand up. Christy Noem and Tom Homan. These people are doing a great job, but gotten them out in records. We have problems with judges that don't want them to go out. They want Tren de Aragua, and they want MS-13, the most vicious gangs ever. Nobody's ever seen anything like it. Absolute killer gangs. They kill people. They don't even think about it. And we put them out, and we have judges now, radical left judges that they don't want them to go out. They want them to even be brought back. Let's bring them back. You've done a fantastic job, and please thank everybody. Homeland Security, thank everybody. Appreciate it. And we now have a border that's the best border that we've ever had, even better than it was my first term. My first term we did good, but this one we really specialized in. We've done really well. And we had records then. We had the best, safest border. 4 years ago, we had the best border there ever was. And now we have, you've actually matched it and done even better. And we're going to get it down the right way. And we want people, by the way, to come into our country, but we want to come in through a legal process. We want them to come in legally. We need more people. We need people to run these plants and to help the auto workers and the Teamsters and the non-union people and everybody else. But we need people, and the farmers. And we're going to let people come in, but they want to come in. We want them to come in legally. They have to have the capability of loving our country, not people that hate our country. We don't want them in our country. And now we're going to pass the largest tax cuts in American history, and that's where we're relying on Mike and John Thune. And we will not cut Social Security, Medicare, or Medicaid benefits, and the Democrats will, because if they got in, the entire economy would collapse. This country was heading for a collapse under the people that you saw. They were horrible. I think one of the reasons people like the job, I have my highest approval ratings because I think they're comparing me to the worst administration in the history of our country, so I appreciate that at least. But Speaker of the House Mike Johnson and Senate Majority Leader, appreciate it, Mike. John Thune have been fantastic, by the way. But they've been working tirelessly on taking the next step to pass the plan for our one big, beautiful bill. I'd like to name it that if you can. One big, beautiful. I made that statement about 6 months ago, and everybody calls it one big, beautiful bill. And it will be that. It'll have everything, the big tax cuts and every incentive there is. And it'll be fantastic. And by the way, for the cars, we're asking for an interest deduction on a loan. So if you build the car, only in America we do it, Brian. If the car's not built in America, you don't get the interest rate deduction. But if you build the car in America, if you buy a car, if it's built in America, then you get an interest rate deduction, tax deduction, and that's a big thing. It's going to be a big thing. I think that's going to pay for itself very quickly, that deduction. Never happened. We've never had anything like that before. Somebody said, where did you get the idea? Because it's so basic. You would think that would have happened a long time ago. It never did, and I'm very happy it didn't, because now I can say that was my idea. But we're going to get us closer to the debt extension. We have to get the debt extension passed, and I know you're going to be able to do that, Mike, and it's very important that you do that. And all of the other things that the Senate budget plan gives us, along with working, because I know they're working together, John and Mike, and the two bills are going very well together. We need to get our shared priorities done, including certain permanent tax cuts. We want the tax cuts to be permanent, spending cuts, energy and historic investments in defense, border, and so much more. We're covering everything. These will be phenomenal. There'll be no bill like this going to straighten. One bill is going to straighten out our country for many, many years to come. And we said, let's just do it and let's get it done. And some guys will love it and some guys will like it a little bit less because they're not getting what they were exactly looking for, but they're getting a lot. They'll never, if we get this done, it'll be the most incredible bill ever passed in the history of our Congress and Senate and congressmen, the senators and the congressmen, many of whom are here today, will be very proud of themselves. I really believe that. It's going to set us on a whole new prosperous path. We're going to cut spending and right-size the budget back to where it should be. We're going to do that very strongly. Thank you, Rick. Thank you. John, thank you. Oh, look at all of our senators over there. Oh, boy. That's a nice group of people. But I won't like them so much if they don't get this bill done. That's a great group. And Congressman, thank you very much. I appreciate it. Tremendous people. The Senate plan is my complete and total support. And the House plan, likewise, is very similar. They're moving along pretty much at the same clip, and as soon as you're ready, you'll show it to me, and I'm sure it'll have my support, Mike. Every Republican congressman and senator must unify. We have to unify. We can't be separated. We have to get it done. We have to get absolutely everything we can, and we have to take care of the American people. That's the only thing that matters. We have to take care of the American people first. We need to pass this bill immediately, get it done, including debt extension. From this day on, we're not going to let anyone tell us that American workers and families cannot have the future that they deserve. We're going to produce the cars and ships, chips, airplanes, minerals, and medicines that we need right here in America. The pharmaceutical companies are going to become roaring back. They're coming roaring back. They're all coming back to our country because if they don't, they got a big tax to pay. And if they do, I'll be very happy, and you're going to be very happy, and you're going to be very safe. We're going to build our future with American hands, with American heart, American steel, and we're going to build it with American pride like we used to. We're approaching our 100th day as president and have been given credit by a lot of people, actually, even some of the fake news. Can you believe it? Which in this case hopefully isn't fake, for having done more in that time than any other administration in the history of our country in the first 100 days. I think we've had an amazing, in terms of what we've done, what we've gotten accomplished. I'd like to see if we can get that war ended and another war from not starting in the Middle East. We have to get Russia. They're losing 2,000 on average, 2,500 people a day, young people, soldiers, Russian. Think of that. 2,500 through some days, but on average, probably over about a 1 week period, it's 2,712, they say. They're losing those soldiers. They're dying They're being decimated, and they're not from our country, but they're from other countries, but they're human beings. They're from Russia. They're from Ukraine in this period, most of them, and we're going to get it stopped. It's a senseless war that would have never happened if I was president, and it shouldn't be allowed to go on. And I think we're being given good cooperation by Russia and by Ukraine, but we have to get it stopped. It's humanity. It's humanity. It's a terrible thing. This will be a very big moment. I think you're going to remember today. It's going to be a free nation that we're dealing with. We're going to have a very free and beautiful nation. It's going to be Liberation Day in America, and it's going to be a day that hopefully you're going to look back in years to come and you're going to say, you know, he was right. This has turned out to be one of the most important days in the history of our country. God bless you and God bless America. Thank you, everybody. Thank you very much. Thank you. Thank you very much.